Section 14. Causes, Impact, and Lessons Learned. Don't default. A month after beginning their foreclosure prevention training, Melissa sat across from David, reviewing several files that looked remarkably similar. Each homeowner had a different story. One had lost a job, another experienced a divorce, one faced unexpected medical bills, another purchased a home with an adjustable rate mortgage they didn't fully understand. Melissa closed the last file. "It's interesting," she said. "Every foreclosure starts differently." David nodded. "That's true, but many of them eventually arrive at the same destination." He stood and walked to the classroom whiteboard. The 2008 housing crisis wasn't caused by one mistake. It was caused by many mistakes happening at the same time. David explained that during the early 2000s, the United States experienced a strong housing boom. Interest rates remained relatively low, home ownership expanded rapidly, and home prices continued climbing. Many buyers believed home values would always increase, encouraging some consumers to purchase homes they could barely afford, while assuming they could refinance or sell before financial problems developed. Melissa remembered their earlier discussions about subprime lending. So rising home prices made everyone feel safe. They did, but markets eventually change. David explained that lenders gradually loosened underwriting standards, approving mortgages for borrowers with weaker credit profiles and in some cases without adequately verifying income, employment, or assets. Many buyers selected adjustable rate mortgages because the initial monthly payment appeared affordable. Unfortunately, many borrowers didn't fully understand that their payments could increase significantly after the introductory interest rate expired. Melissa asked, "So what finally caused everything to collapse?" David drew a simple domino effect on the board. It started slowly. As interest rates increased, monthly mortgage payments also increased for many homeowners with adjustable rate loans. At the same time, home prices stopped rising. Borrowers who had planned to refinance suddenly found themselves unable to qualify for new loans. Others owed more than their homes were worth. As mortgage payments became unaffordable, defaults and foreclosures increased across the country. "But that only explains the homeowners," Melissa said. "What happened to the banks?" David smiled. "That's where the secondary mortgage market enters the story." He explained that after many lenders originated mortgage loans, they frequently sold those loans into the secondary mortgage market instead of keeping them. Government-sponsored enterprises such as Fannie Mae and Freddie Mac, along with investment banks, purchased large numbers of mortgages. These loans were pooled together into mortgage-backed securities, MBSs, and sold to investors throughout the world. This process created liquidity, allowing lenders to make additional mortgage loans while providing investment opportunities for financial institutions. Melissa nodded. "So one homeowner's mortgage might eventually be owned by someone completely different." Exactly. David explained that when mortgage payments stopped, investors holding those mortgage-backed securities also experienced losses. As defaults increased nationwide, the value of those investments fell dramatically. Major financial institutions suffered enormous losses. Several collapsed, credit markets froze, and lending nearly stopped altogether. The housing crisis quickly expanded into a worldwide financial crisis, affecting millions of families, businesses, and investors. Melissa looked surprised. "I didn't realize one mortgage could affect so many people." "It usually doesn't," David replied, "but millions of mortgages can." He explained that the crisis affected far more than homeowners. Banks tightened lending standards. Businesses struggled to obtain financing. Construction slowed dramatically. Consumer confidence fell. Unemployment increased, and countless families lost both their homes and their retirement savings. The financial crisis demonstrated how closely connected housing, banking, employment, and the overall economy truly are. Melissa then pointed to a chart showing various mortgage programs. "What role do Fannie Mae, Freddie Mac, Ginnie Mae, and VA loans play today?" David explained that these organizations help provide stability and liquidity within today's mortgage market. Fannie Mae and Freddie Mac purchase qualifying conventional mortgages from lenders, helping lenders continue making new loans. Ginnie Mae guarantees mortgage-backed securities backed by government-insured loans such as FHA, VA, and USDA mortgages, encouraging investment while helping expand affordable homeownership opportunities. The Department of Veterans Affairs, VA, guarantees a portion of eligible veterans' home loans, reducing lender risk while allowing qualified veterans to purchase homes with favorable financing terms. Melissa smiled. "So these programs aren't just helping lenders, they're helping keep the housing market functioning." Exactly, David concluded the lesson. "The greatest lesson from 2008 isn't simply that markets rise and fall. It's that every participant in a real estate transaction has responsibilities. Lenders must responsibly underwrite loans. Borrowers must fully understand the loan they accept. Investors must accurately evaluate risk. And realtors must educate consumers, encourage responsible decision-making, stay within the scope of their license, and always protect the public." Melissa closed her notebook. The housing crisis changed how mortgages are made. It also changed how realtors serve their clients. David smiled. And that's a lesson worth remembering. In the next section, we'll move away from the causes of default and begin examining the practical alternatives available to homeowners before foreclosure occurs, including how realtors can help identify solutions that may allow clients to keep their homes or avoid foreclosure altogether.